second quarter of the year saw continued gains across all major market indices. Year to date, small company stocks returned nearly 25%, while the S&P 500 is up about 15% since the start of the year. Equity returns have been broad-based, with every sector higher year to date. Energy companies continued their bounce after poor returns in 2020, while financials and real estate also rebounded. Valuations remain elevated, with the forward price-to-earnings ratio at 21 times. However, valuations have declined off highs seen earlier in the year, primarily because earnings have rebounded. After declining 14% in 2020, S&P 500 company earnings have made a strong comeback. Including analyst forecasts through the end of 2021, earnings are estimated to rise 38% relative to last year. Thanks to stimulus from the U.S. government and forced savings from not spending on travel and leisure in 2020, consumer balance sheets are healthy. The personal savings rate as a percent of disposable income is near record highs. As countries open their borders to tourists, pent-up travel demand should drive spending. We initiated a position in Booking Holdings, the world's largest online travel agency. As consumer spending shifted during the pandemic, many goods-producing companies saw surprise surges in demand. At the same time, COVID-related bottlenecks on the logistics side has led to tightened capacity to transport goods. This supply chain bottleneck remains one of the inflationary forces at play, although this may resolve as the reopening continues. The surprising spike in demand for goods has also led to supply and demand imbalances that have squeezed the prices of some raw materials. Lumber prices rose to 4 times typical levels by the beginning of May. However, prices have retreated since then as sawmills have stepped up production to meet the increased demand and prices. The U.S. is still down 6.8 million jobs since the start of the pandemic, but many companies are reporting difficulty hiring, and job openings have risen. People may be reluctant to return to the labor market for a number of reasons: increased unemployment benefits, lingering pandemic fears, and lack of childcare over the past year, with many schools maintaining remote learning. September could be a turning point, with children returning to in-person school and extra unemployment benefits expiring in all states. The tight labor market, supply chain bottlenecks, and the massive amount of monetary and fiscal stimulus have led to concerns that we may see inflation running away. The most recent headline Consumer Price Index, or CPI, number was 5%, the highest in over 13 years. However, this number was disproportionately affected by things like the price of used cars, which rose over 30% as rental car companies faced inventory shortages upon reopening, and a continued semiconductor shortage crimped the supply of new cars. Scraping out these volatile items and looking at median CPI, the gain was much more muted at 2.1%. The price of shelter accounts for roughly 40% of the total Consumer Price Index number. This does not track the price of homes, but rather owner's equivalent rent. Home rental prices have bounced off the bottom since declining significantly in the pandemic, but is still much lower at just over 2%. The Federal Reserve recently adjusted its forecast from 0 rate hikes by the end of 2023 to 2 increases. Most Fed governors have continued to reiterate that they believe inflationary pressures in the economy are largely transitory, but that they are monitoring and will act accordingly if inflation begins to run ahead. Bond yields rose sharply in the first quarter as many investors believed that the economic reopening would drive higher inflation. However, rates declined from the peak of 175 to below 150 by the end of June, and have since fallen to about 125. Some economists have touted the idea that peak growth may be behind us, particularly as the Delta variant threatens to slow reopening momentum. The recent pivot by the Fed has also led investors to worry less about runaway inflation, as they have confidence that the Fed is not complacent about rising prices. While U.S. valuations remain elevated, international equity valuations are trading at a significant discount on a relative basis. Dividend yields have also risen relative to those of U.S. companies. At the same time, credit ratings have improved on emerging market debt, leading to lower financing costs. The growth of the middle class in emerging market countries over the next decade should act as a positive catalyst for this group, particularly in China and India. If inflation does indeed head higher, emerging market investments should perform well. These investments have done well historically in high or rising inflation environments. We recently added to our position in emerging markets based on the relatively attractive valuation, secular growth of the middle class, and improving credit environment. As the millennial generation enters the age of home buying, they have been met with higher prices alongside record low housing inventory. We initiated a position in D.R. Horton, a home builder focused on the entry-level space, who should benefit from millennial household formation. As the equity market continues to rise, valuations are stretched but have declined off recent highs, primarily due to company earnings rebounding. Meanwhile, supply chain pressures and labor market tightness are causing inflation, but these may be transitory in nature. The Fed believes this is the case and is confident that they can keep inflation under control. We think inflation is likely to stay around the 2 to 2.5% level. Inflation at this moderate level would be considered healthy, and so we're focusing on cyclical companies that are levered to an improving economy, as well as adding emerging markets international exposure.